Hello guys, welcome back to my YouTube channel. As usual, to my returning subscribers, thank you so much for your support. I never take it for granted. And also to my new subscribers, please leave a like, comment, and turn on your notification bell so whenever I do post a video, you get instant updates. As I mentioned in my previous video, I'll be talking about investing for the next couple of weeks. I talked about why you should invest in my previous video. In this video, I'll be talking to you about the different kinds of investments you can make, and I'll be going into detail in subsequent videos on some of them, so please stay tuned. And don't forget to turn on your notification bell for any updates, and please leave a comment on any of the videos if you have anything to input that you think will help the other audience as well. Without further ado, let's get right to it. The first kind of investments that we have are called stock. When you invest in a stock, you become one of the owners of the corporation. Stocks represent ownership shares, also known as equity share. Whether you make or lose money on a stock depends on the failure or success of a company, what's going on in the market overall, and what kind of stocks you own. There are a bunch of other factors that also factor in as to whether your profit per price goes up or goes down. So it can be a kind of an unwinding kind of activity. It can be trading sideways, it can be trading on the up in the bull market or down in the bear market. Stocks and stock mutual funds can often be an important component of diversified investment portfolios. Now, in terms of returns, stocks can be grouped into two overall categories when it comes to the returns you make on them. The first is dividends. When publicly owned companies are profitable, they can choose to distribute some of those earnings to owners by paying a dividend. You may either receive the dividend payment in the form of cash, or you can reinvest into the company by buying more shares of the company. What I usually recommend is to just reinvest in the company if you believe that company is going to grow long term. Many retired investors like to focus on stocks that generate regular dividend income to replace income they are no longer receiving from their jobs. Stocks that pay a higher than average dividend are sometimes referred to as income stocks. The second form of returns is simply known as capital gains. Stocks are bought and purchased constantly every day, and their prices change all the time. When the stock price climbs higher than what you paid for, you can actually sell your shares for a profit. These profits are known as capital gains, and depending on how much you make within the tax year, you actually get taxed on them. In contrast, if you sell a stock price for lower than you bought it, you've incurred what's called a capital loss. The second type of investments that you can make are called bonds. A bond is a loan that an investment makes to a corporation, government, federal agency, or any other organization in exchange for interest payments over a specified term, plus repayment of principal at the bond's maturity date. When you invest in bonds and bond mutual funds, you face the risk that your investment might lose money, especially if you bought an individual bond and want a need to sell it before it matures. Additionally, bond mutual fund prices can fluctuate as stock mutual fund prices do. Risk will also vary depending on what kind of bond you own. Since bond issuers know you aren't going to lend your hard-earned money without compensation, the issuer of the bond enters a legal agreement with you to pay you interest. The bond issuer also agrees to pay you the original sum of the bond at the bond maturity date. However, certain conditions such as a bond being called may cause repayment to be made earlier. The third type of investments that you can make are called mutual funds and ETFs. Investment funds pool the money of many investors and invest according to a specific strategy. Funds come in various types, each with different features. Generally, publicly offered funds such as mutual funds, exchange-traded funds, closed-end funds, and unit investment trusts must be registered with the SEC as investment companies. The SEC is also known as the Securities and Exchange Commission. Private investment funds, often called hedge funds, are exempt from this kind of registration. A mutual fund is a fund that pools money from many investors and invests it according to specific investment goals. The mutual fund raises money by selling its own shares to investors. The money is used to purchase a portfolio of stocks, bonds, short-term money-making instruments, other securities or assets, or some combination of these investments. Each share represents an ownership slice of the funds and gives the investor a proportional right, based on the number of shares that he or she owns, to income and capital gains that the funds generates from its investments. Exchange-traded funds, also known as ETFs, combine aspects of mutual funds and conventional stocks. Like a mutual fund, an ETF is a pooled investment fund that offers an investor an interest in a professionally managed and diversified portfolio of investments. But unlike mutual funds, ETF shares trade like stocks on stock exchanges and can be bought or sold during the trading day at fluctuating prices. The next kind of investments you can make are in the form of retirement accounts. Saving for retirement and managing income once you retire are two important aspects of personal financial management. When it comes to saving, tax advantage options such as a 401k or IRA can be smart choices. In addition to potential tax benefits, there is an opportunity for your savings to compound over time. FINRA's Smart 401k resource provides information on how 401k plans work, whether you're getting started or you're already retired. I'll put the link in the description. 401k plans are a type of salary deferral plan that is set up by a private sector employer. Similar salary deferral retirement plans include a 457 plan for public sector employees and a 403b plan for nonprofit sector employees. Salary deferral plans are typically self-directed. That means that you're responsible for how much you invest in the account. Usually you must choose among a list of investments that the plan offers. The advantage of self-direction is that you have the opportunity to choose investments that you believe will help you achieve your long-term goals. But of course, it also means that there's an added responsibility for choosing wisely. Your employer may also choose to contribute to your account. Typically, it's a match of some portion to the amount you contribute. An IRA, on the other hand, may either be an individual retirement plan that you may set up with a bank, a brokerage firm, a mutual funds company, or even an individual retirement annuity through an insurance company. There are two kinds of IRAs. There are traditional IRAs and Roth IRAs. Traditional IRAs can be classified into two tax-deferred categories, known as deductible or non-deductible. If you qualify to deduct your contributions, you can subtract the amount you contribute when you file your tax return for the year, reducing the income tax you owe. If you don't qualify to deduct, the contribution is made with after-tax income. The IRS website has resources to help you figure out whether you can and to what extent you can deduct your contributions. I'll leave a link in the description box. Earnings on investments in a traditional IRA are tax deferred for as long as they are in your account. When you take money out, which you can at 59.5 and you are required to at 72, your withdrawal is considered regular income, so you owe income tax on the earnings at your current rate. If you deducted your contributions, your tax will be due on the entire withdrawal amount. If you did not deduct your contributions, on the other hand, tax is only due on the portion that comes from your earnings. Previously, an individual was able to contribute to a traditional IRA up to the age of 70.5. However, under the Secure Act of 2019, this age limit has been eliminated. Any individual who still has earned income in the year 2020 and beyond may actually contribute to a traditional IRA, as well as a spousal traditional IRA. In fact, the Secure Act allows anyone who is working and has earned income to contribute to a traditional IRA for as long as desired, even if you have not contributed to an IRA in the past. Contributions to Roth IRAs, on the other hand, are always made with after-tax income. But the earnings are tax-free if you follow the rules for withdrawals. You must be at least 59.5 and your account has to have been open for at least 5 years. What's more, with a Roth IRA, you're not required at any age to withdraw your money. You can even pass the entire account to your heirs if you choose to do so. And you can continue to contribute to a Roth IRA for as long as you have earned income. And it doesn't matter how old you are. Contribution levels for a Roth IRA are the same as the contribution levels for a traditional IRA. However, there are income restrictions that are associated with contributing to a Roth IRA. If you have a spouse, both of you can actually set up your own IRAs. Thank you so much for tuning in to today's video. I hope you found it informative. It was a lot of information, I know, but it's very important that we learn these things and help continue to grow. Learning these things puts us one step closer towards financial freedom. Please leave a like on the video if you enjoy the content. If you have any questions, comments, concerns, please leave it in the comments down below, or just comment if you enjoy the content. It really helps me with the YouTube algorithm. It helps me push this information out there further out and gain more exposure. So again, I really appreciate all your support. I hope you enjoyed this video and I hope you have a great week. Catch you guys later.